This conference will now be recorded.
Okay, now instead of asset accounting, let us talk something different. Probably let us talk about foreign currency valuation. Anybody heard this foreign currency valuation before? What is this foreign currency valuation all about? Is this a month-end activity or year-end activity?
Month end, sir.
Activity.
Right, foreign currency valuation is a month-end activity. Now, when you talk about foreign currency valuation, so this is purely related to entries posted in other than local or company code currency, because you are going to evaluate foreign currency transactions. Okay, you are going to evaluate foreign currency transactions, which means these transactions are other than your local currency transaction. If you take our company code as an example, which is DEIN, for our company code we've used the local currency as INR. Any transaction which is posted in INR currency, is this part of local currency transaction or foreign currency transaction? If you post any entry in INR, this is called as local currency transaction. All your local currency transactions are excluded from foreign currency valuation. Anything which is posted apart from INR, like your USD, AED or any other currency, that will be part of your foreign currency valuation. This foreign currency valuation is applicable for which kind of account? You have two type of accounts. We have P&L accounts, you have balance sheet accounts. Are we going to evaluate this foreign currency for P&L accounts or for balance sheet accounts or for both the accounts? I am going to use FCV from now onwards. FCV represents foreign currency valuation. This foreign currency valuation is used for what accounts? P&L or balance sheet or both? Which accounts? Is used for balance sheet accounts only, not for P&L. Your foreign currency valuation is strictly used for balance sheet accounts, not for P&L accounts. Okay, now in balance sheet I'm going to write shortcuts. I'm not going to write everything in detail. When I write BS, make sure you read that as balance sheet. When I put FCV, make sure you read that as foreign currency valuation. In balance sheet we have two types of accounts. Okay, what are those two type of accounts in balance sheet? Assets and liabilities. Is this correct? We have assets and liabilities in your balance sheet. Now, in balance sheet, assets and liabilities, GL account can be two types again. In your balance sheet, either asset or liability, this GL account can be two types again. What are those two types of your asset and liability?
Normal GL, open item GL.
Correct. So you have open item managed GL accounts and non-open item managed GL accounts. Okay, you have open item managed GL accounts, non-open item managed GL accounts. Is this foreign currency valuation applicable for open item managed GL accounts or non-open item managed GL accounts, or for both?
Both.
right? FCV is valid for both open item management and non-open item management GL accounts. Make sure you read the shortcuts properly. OIM represents open item management. Alright. Now, are we going to use this foreign currency valuation for all the accounts or for selected accounts? FCV is not used for all balance sheet accounts. It is used for selected GL accounts only. Right? You're not going to evaluate all the balance sheet accounts of yours. Instead, you are going to evaluate only the selected balance sheet GL accounts. Right? Now, if you do foreign currency valuation, what is going to happen? If you do foreign currency valuation, what is going to happen? Ideally, this is recommended to be used for all the accounts or only open item or non-open item. Foreign currency valuation is recommended to perform for open item managed GL accounts or non-open item managed GL accounts or for all the balance sheet GL accounts. What is the ideal approach? What are we supposed to use this foreign currency valuation? FCV is recommended for open item managed GL accounts only. Why for open item managed GL accounts only? Why not for all accounts? Why not for non-open item managed accounts? Any idea, anyone?
For open item, when the amount is get open, that currency valuation is getting changed.
Right. So open items will represent current liability or asset. Correct? Open items will represent either current liability or current asset. Is this point correct? In short, open item management will represent payables or receivables in foreign currency. Okay, open item management will represent payable or receivable in foreign currency. Anything that you are paying or anything that you are going to receive in foreign currency will have to be converted into local currency. Now, by now, I hope everybody is clear. Any document that you post in your company code must have minimum 2 currencies. What are those minimum two currencies for every document?
Local and
Mandatory
foreign.
currency in a document.
Local currency.
First, let's talk about two currencies. What are the two mandatory currencies in a document? DC and LC. What is DC?
Document currency.
Document currency.
DC is your document currency, LC is your local currency. These are two minimum mandatory currencies in every document that you post in SAP. Without document currency, you cannot record the transaction. Without local currency, you cannot have a company code. Because when you're creating a company code, currency is mandatory. And when you're posting a document, currency is mandatory. While posting the document, you are going to input the document currency. This document currency is automatically converted into local currency by the system. So these two are your two minimum currencies that you are going to use. In case if you want to use three currencies, what will be the three currencies? DC is common, LC is common. What will be the third currency?
GC, group currency.
Group currency. Likewise, you can use multiple currencies. If you want to use four currencies, let's say if you want to use four currencies, DC will be common, LC will be common, GC will be common. Fourth currency can be either hard currency or index based currency. That will be either HC or IC, index based currency. Correct? Depending on the requirement, you are going to choose number of currencies that you want to use in your company code. Now, when you're talking about foreign currency valuation, system is going to look at which currency of a document. Is this DC, LC, GC or HC? Based on which currency your foreign currency valuation is going to work. Which currency system is going to look for? FCV is based on document currency. Correct? Is this correct?
Yes, sir.
How we are going to identify whether a document is posted in local currency or foreign currency? It is purely based on the document currency. It is purely based on the document currency. If your document currency is your local currency, which is your INR, this is excluded or this is not relevant for foreign currency valuation. If your document is posted other than INR, let's say you posted a document in US dollar, USD, this USD transaction is applicable for your foreign currency valuation. Now, why we have to do foreign currency valuation? Now, any entry
To pay loan.
posted in foreign currency must be converted into local currency for reporting purpose. Is this correct? Any entry that you post in foreign currency must be converted into local currency for reporting purpose. You're not supposed to submit your reports in foreign currency. Assuming you're operating in India you're supposed to prepare your financials strictly in INR currency. That doesn't mean you're not supposed to perform any transaction in other than INR. You are free to perform transaction in any currency, but make sure your foreign currencies are converted into local currencies and then reporting happens only in INR. In short, the currency in which you are supposed to report according to the respective accounting principle. Now, whenever you are performing any transaction in foreign currency, there is something called conversion. There is something called conversion. Foreign currency amount will be converted into local currency amount based on exchange rate. Is this point correct? Foreign currency amount will be converted into local currency based on exchange rate. Are we going to have fixed exchange rate every time, or these exchange rates are subject to change?
Subject to change.
Right? These exchange rates are subject to change. Now, what might happen? Let's say today when you record a transaction, exchange rate may be 1. Tomorrow when you clear the transaction, exchange rate may be 1.2. Now the currency conversion is not same. whenever there is a deviation or whenever there is a difference between your currency conversion or the currency exchange rate, you are going to receive the differences in the currency conversion. This currency conversion differences is what you are going to capture in your foreign currency valuation. Let me write one example here, then I'll write additional points here. Let me put example number 1. Point number 1 that you have to keep in your mind is foreign currency valuation is strictly used for balance sheet accounts. In balance sheet, your primary focus is on open item management accounts. Point number 1, balance sheet accounts. Point number 2, open item managed accounts. Open item managed account will represent either payable or receivable. In short, amount that we are supposed to pay or amount that we are supposed to receive. In short, either current asset or a current liability. I'll put one example like vendor purchase invoice from, let's say, USA for 1000 US dollar at the rate ATS exchange rate. Clear? Instead of USA, I'll say from Microsoft. Okay, vendor purchase invoice from Microsoft for $1000 at the rate 80 rupees as exchange rate. Now, when we have to write this accounting entry or when we have to record this entry, this is an import purchase. Am I correct? This is a foreign currency transaction. Is this point correct? This is a foreign currency transaction. Agree with me?
Yes.
Why is this foreign currency transaction? On what basis we are telling? To tell whether this is your foreign currency transaction or a local currency transaction, first thing you need to understand what is your company code. First point you need to keep in your mind, what is your company code? If your company code is DEIN, what is the currency of your company code? Assuming your company code currency is INR. Now, did we purchase in INR? No, we purchased in dollars. If your purchase took place in dollar, this is called as a foreign currency transaction. If your purchase took place in INR, this is called as your local currency transaction. First thing that you have to understand to segregate what is your foreign currency transaction, what is your local currency transaction. That is the first point. Clear everyone how to identify if a particular transaction is local currency or foreign currency? For that, you need to keep in your mind your company code and company code currency. Then verify the transaction currency. Then it's easy for you to identify. To record this accounting entry, you are going to pass a journal entry for booking this invoice. Now, I'll put invoice entry. This invoice entry will be, let's say, purchase account, debit, and Microsoft account credit. Is this correct accounting entry? Purchase account debit, Microsoft account credit. You will have to mention the amount both in local currency and in your foreign currency. Since you are recording the entry in foreign currency, you will have to ensure you put the amount in dollars. You are also going to convert every amount that is posted in foreign currency into local currency. I'll put INR. Now INR, let me put this is at the rate 80. The purchase value is $1,000. I'm going to put $1,000 on the debit, $1,000 on the credit. Make sure your debit credit is becoming 0. Similarly, you have to convert this 1000 equivalent into INR. You are going to convert this by multiplying 1000 into 80 because this is your foreign currency to local currency conversion is always multiplication. Is this correct? Similarly, this multiplied by 80. If I do a total for local currency, this is also becoming 0. Is this entry clear for everyone? Nothing new in this. This is something that we are all already aware of. Anything new in this accounting entry, or it is clear? Clear, right? Now this is your invoice. Whenever you have an invoice, you will have the corresponding another transaction. What is that corresponding transaction against an invoice? Payment, right? We are supposed to make the payment to the vendor. If you purchased from a vendor in dollars, are we supposed to pay to the vendor in dollars or in INR? We purchased from a vendor in dollars. Are we
Dollars.
supposed to pay to the vendor
by dollar?
Right, we'll have to pay to the vendor in dollars only. Now let me write this payment entry. Okay, when you're writing the payment entry, you are going to write another accounting document. What will be that accounting document at the time of payment? It will be your Microsoft debit, which means your vendor debit, your bank outgoing credit. Now same thing, you'll have to put dollar, you'll have to put INR. Since you purchased in dollar, your vendor is expecting $1,000. You are going to put 1,000 on the debit. You are going to put 1,000 on the credit. Okay, 1,000 on the debit, 1,000 on the credit. If I do a total, is this becoming 0? My payment in dollars? My invoice amount, my payment amount, are they becoming 0? $1,000 I purchased, $1,000 I paid. It has become 0.
0.
Now, assuming when you are making the payment, the exchange rate is 81 rupee. Is this possible or not?
Yes, sir. It's possible.
It is possible because whenever you purchase anything from any vendor, you are going to have something called payment terms. If you purchase today, you may be paying after a month, after 2 months, after 3 months. By the time you initiate the payment, there may be different exchange rate. But your payment is always in dollars. But according to the legal requirement, you are supposed to convert all your foreign currency payments or all your foreign currency transactions into local currency by using exchange rate. If there is a deviation, if there is a fluctuation in the exchange rate, your local currency values will automatically get affected. Now, in this case, you are going to multiply this 1000 with 81 rupees. Similarly, this 1000 with 81 rupees. Now, if I do a total here, at the document level, is this also becoming 0? Yes, no? Just to see this from a transaction point of view only. This is also becoming 0. right? It is also becoming 0. From the document point of view, this is a separate entry, this is a separate entry, because one is invoice, the other one is payment. But if you see it from a vendor point of view, this is an invoice, this is a payment. First you purchased, based on the purchase you have made the payment. This payment is made against this invoice. What is my liability in dollar? 1000, correct?
Yes.
My liability to the vendor is 1000, but to the vendor how much I paid? 1000. To the vendor I paid 1000. Now let me do a total is equal to my invoice amount plus my payment amount. Is this becoming 0? Invoice amount is $1000, payment amount is $1000. In dollars, I have cleared the liability completely. Let's do it the same calculation from the INR point of view. Our INR liability is 80,000, but our INR payment is 81,000. Did we pay the exact amount, or we paid more, or we paid less?
We paid more.
We paid more.
We paid more. Now let me do a total for this. Let me take this plus this. Sorry, not this one. It is this. Is equal to your invoice plus payment. Is this becoming 0, or there is any value?
There
1000.
is a value.
It did not become 0, it has got a value. What is this value? This value is 1000. What is this 1000? Positive, negative?
Positive.
Change loss.
This 1000 is a positive number. Now you'll have to look at nominal account rule. You have debit, you have credit. According to nominal account, debit is what? Expense and loss. Credit is what? Income and gain. Debit means positive number, credit means negative number. Are we getting a positive number, or are we getting a negative number here?
Positive number.
Positive.
We are getting a positive number. Positive number means debit balance. According to nominal account rule, debit balance represents expense or loss. Now this is called as loss.
Loss.
This is called as a loss. Now this is what you are going to treat with your open item management. This is what you are going to treat as open item management. Now, if you create any GL account master, let me open SAP now. It's not working. May try ECC. No. Okay, let me go to GL master FS00. If I select any GL account, let me select any one balance sheet account. Cash bank. If you go to GL account master data, control data tab, you will find something called open item management. You will find something called open item management. Now currently, is this enabled or disabled? Ticked or unticked? If it is ticked, this means this GL account is managed as open item management. Any GL account which is enabled as open item management is subject to clearing. If you are creating a GL account as open item management, this GL account is subject to clearing. When you are performing a clearing, you are matching debit and credit. Okay, if you put a GL account as open item management, that respective GL account requires debit and credit matching like this. Now to do the matching, you are performing a clearing activity. This clearing is either automatic clearing or manual clearing. When you are performing this clearing, you are trying to match debit with credit. If I am trying to match this debit with this credit, system is going to look at what is my debit balance, what is my credit balance. Similarly, system is going to look at what is your debit balance, what is your credit balance. If debit and credit are the same, it will not give you any message, it will pass the entry. In case if the debit and credit are not the same, if there is any mismatch, if there is any deviation because of exchange rate fluctuation or because of exchange rate difference, system is going to trigger or system is going to determine the difference. That difference is called as your exchange loss or exchange gain. Now this amount we call it as exchange loss or gain. This difference is called as exchange loss or exchange gain. How we came to know that this is loss or gain? Because you have compared previous transaction with the match of transaction. Whenever you verify the previous transaction with match of transaction, in short, your original entry with clearing entry, system is going to look at the exchange rate in the original entry. System is going to verify the exchange rate in the clearing entry. If these two are same, it will allow you to pass the entry without any errors. If they are not the same, option number 1, it will give you an error message if there is no configuration maintained. Option number 2, if the configuration is already maintained, it is going to trigger the exchange rate differences. It is going to trigger the exchange rate differences. This exchange rate difference is called as exchange loss or exchange gain. This exchange loss or exchange gain is of two types. One is your exchange loss or gain is of two types. One is realized exchange loss or gain. Second one is your unrealized exchange loss or gain. Clear? First one is your realized exchange loss or gain. Second one is your unrealized exchange loss or gain. Unrealized and realized, you have to understand the difference. This is your actual settlement. Realized exchange loss or gain will come into picture when you're actually doing this settlement. Okay, actual settlement or clearing. Now unrealized exchange loss or gain will come during your month end process with foreign currency valuation. Okay, month end process with foreign currency valuation. This is an assumption to capture the P&L impact. Your unrealized exchange loss or gain is a month-end process with foreign currency valuation. This is just an assumption to capture the P&L impact to ensure that your P&L figures are accurate, because this is a liability or this is an asset to be received or to be paid in foreign currency. Whenever you receive any amount from foreign currency or whenever you make any payment in foreign currency, you are subject to receive exchange loss or gain. This exchange loss or gain is of two types. One is your realized, the other one is unrealized. Realized is going to happen when you are actually doing the settlement or clearing. You are going to do nothing with this. When you are actually settling, you are going to have the actual impact. So you are going to do nothing with it. This is excluded. But what if the transaction is still open at the month end, but you want to know if I pay this amount in this month or if I receive this amount in this month, what would be my P&L impact? Whether I would have made my forex loss or forex gain. To do this calculation, to compute this figure, we are going to perform foreign currency valuation at the end of every month in every organization. Some clients will do it on a monthly basis, some clients will do it on a quarterly basis, some clients will do it on a yearly basis. So using this foreign currency valuation on a month end is optional, on quarterly is optional, but at year end it is mandatory. At year end you must perform foreign currency valuation in every company code, but it is not mandatory to perform on a monthly basis. It depends. Okay. Now realized exchange gain or loss will be the final entry or the actual P&L impact. Okay, whereas unrealized exchange gain or loss is an assumption and it will be posted in the current month last date and reversed next month first date. Okay, unrealized exchange loss gain is an assumption and this will be posted in current month last date and reversed next month first date, which means if you are performing foreign currency valuation for the month of May 2023, your foreign currency valuation is going to pass two accounting entries. One is the actual impact in the current month, second is the reversal of this impact in the next month. On 31st May, it is going to pass the entry. The same entry is reversed on 1st June. Is this clear? Is this correct? You are going to pass the entry on 31st May and the same entry will be auto reversed on 1st June. Because this is not the original impact, this is just an assumption to compute your P&L properly. Now, if you look at this, there is a difference. Now, let me take the extract of these two transactions only from the vendor point of view. I'll write vendor account, or let me write at the bottom. Let's write as vendor account. In this vendor account, you are going to have item number 1, item number 2. Item number 1 is your invoice. Item number 2 is your payment. Okay, I'll put dollar here I'll put INR here. One is your document currency, the other one is your local currency. Now, what is the dollar purchase amount? It is 1000. Your invoice is showing 1000 credit balance. This 1000 credit balance is equivalent to 80 rupees, which means 80,000. I'll put this multiplied by 80. Okay, 80,000 is your liability. Assuming at the time of payment, the exchange rate has become 81. So you are not going to bother about exchange rate because you are supposed to make the payment to the vendor in dollar currency. You are only going to see the dollars. You purchased for $1,000, you paid $1,000. So $1,000 has become zero. Your vendor account balance has become zero from the dollar point of view. But when you paid this dollar, the exchange rate on this particular date is 81. According to this, $1,000 multiplied by 81 rupee, it has become 81,000. If I do a total for this, I'm not getting this account balance as zero. There is a residual value or there is a balance left over as 1,000 rupees. Now this 1,000 rupees, you are getting a balance in which currency? Is this balance coming in foreign currency or in local currency?
Local currency.
Clear? Foreign currency is performed for foreign currency valuation is performed for foreign currency entries, and financial impact is posted in local currency only. Is this statement clear? You are going to perform foreign currency valuation for foreign currency entries, but financial impact is posted in local currency only. Nothing is going to get posted in dollar, because do you find any difference in dollar, or it is exactly matching?
Exactly match.
Dollar is exactly matching, there is no difference here. But on the other side, when you look at the INR, it is not exactly matching, difference is coming. Now, whenever you perform foreign currency valuation, always keep in your mind, your foreign currency valuation is going to pass the entry only in local currency. Your document currency will be zero, only local currency will show the amount. You might get these kind of a questions if somebody is taking your interview on these points. Right? So it's not about performing the configuring foreign currency valuation, it's about understanding the logic behind the foreign currency valuation. Now this entry is going to come. Now can we close the vendor account with this balance? If I want to close the vendor account, I need to ensure vendor account balance in dollar is zero. Vendor account balance in INR is also zero. Is this becoming zero in INR? No, right? It is not becoming zero in vendor account. So what we need to do, we need to take this 1000 into a different GL account. You need to treat this 1000 as loss or gain. Is this a loss or is this a gain to us?
Loss.
It's a loss to us. So what you are going to do, this 1000 is treated as a loss. Now the calculation remains exactly the same both in your realized and unrealized. That is why I'm not writing realized unrealized here. I'm only writing loss because the calculation logic is exactly the same. This 1000 is a loss. To close the vendor account, how much I should pay actually? 81 or 80?
81.
I'll put INR 1. This will be your 80,000, and here also it should be 80,000. Here also it should be 80,000, but we need to ensure that this amount is becoming 0. But here it is 81,000, you are getting a difference of 1,000. This 1,000 you are going to take this here. Now this is your invoice amount, this is your payment amount, this is your forex loss. So your accounting entry for payment is going to have 3 line items: one bank account line item, one vendor account line item, one forex loss line item. So if you write this accounting entry, it will be, now the accounting entry is different when it comes to, now is this calculation clear before we write the accounting entry for this?
Yes, sir.
This calculation why we are getting 1,000 difference is clear, right? Accounting entry in case of realized or actual settlement or actual clearing. Here you are going to put vendor debit for 80,000, bank outgoing. You are going to credit 81,000, bank outgoing credit for 81,000. Now if you do a total, there is a balance of 1,000. There is a balance of 1,000. Now this 1,000, when you see it from here, you are getting a positive number, but when you see this from here, you are getting a negative number. Now how we are going to account this? Are we going to debit this or credit this?
Credit.
Now
Credit.
in this example, we assumed this is a loss. Loss according to nominal account is always debit. Now when I do this calculation here, I am getting a credit balance. I am getting a credit balance. When I am getting a credit balance, which means which side is more, credit or debit?
Credit.
Credit side is more. Now to complete the accounting entry, I need to ensure my debit and credit is matching or not matching. I need to ensure my debit and credit is matching to pass the entry. Am I correct?
Yes, sir.
Correct? Huh? Now to match debit and credit, which side the shortage is there, on the debit side or on the credit side? 1,000 is the difference.
Debit.
This
side.
1,000 is the difference on the debit or on the credit?
On the debit side, sir.
On the debit side. So this is called as forex loss debit. I'll put 1,000. Now did this become 0 now? It has become 0, your document. Now this is the accounting entry that you are going to pass in case of realized. In case of unrealized, now let me put accounting entry in case of unrealized or foreign currency valuation. So when you are doing unrealized or when you are performing foreign currency valuation, is this actual settlement, actual clearing or actual payment, or this is just an assumption? Foreign currency valuation is actual settlement or this is an assumption? What is this?
Just assumption.
Foreign currency valuation is straightforward as an assumption. This is not the actual settlement. This is just an assumption. Now, if you are assuming, you will have to debit and credit the same impact. What is the difference? Now, the calculation here is a slightly different. So, what you are going to do, you are going to take the amount which is your invoice amount. Invoice amount is 1000. Invoice amount is how much? 1000, and exchange rate is 80. Is this correct? Invoice amount is $1,000.
Yes, sir.
Exchange rate is 80 rupees. Now you'll have to write MER is 81. MER is your month end exchange rate. MER represent month end exchange rate is 81. Now system is going to perform a formula, or system is going to calculate based on a predefined logic. What it will do, it will take your FC amount multiplied by difference in exchange rate. FC amount multiplied by difference in exchange rate. Your foreign currency amount is how much? 1000. Correct? Multiplied by 80 minus 81 is how much? 1.
1.
So it is straight away going to give you 1000 as loss. This is straight away going to give 1000 as loss. Now this 1000 loss will have to be accounted. Now this 1000 loss will be debited again. Let me write a little down here. Forex loss debit, and then you'll have to credit two accounts. Option number 1, you can use the same GL account like accounts payable credit or exchange rate clearing account credit. Either this or this you can use. The ideal approach is the respective GL account will have to be credited. In this case, it is your accounts payable. This will be your accounting entry in case of this will be the accounting entry in case if you are performing unrealized or foreign currency valuation. Now how these numbers are going to get calculated by the system is what we have to practically understand with some kind of examples like you have on your Excel sheet. What we will have to do, we will have to configure foreign currency valuation, which is a simple configuration, and you have to understand it logically. When we say that you have to understand this logically, you have to understand in such a way, if you open a particular vendor account report or any particular open item managed GL account report, before you perform the foreign currency valuation for that particular GL account, if you run the report, let's say /n FAGLL03 execute, assuming these are the GL accounts, ignore what is this currency and all. How many entries are there? You have 7 entries here, correct? You have 7 entries displayed here. Now I'll take this into Excel sheet. I'll just manipulate the data to make sure what exactly I want you to understand. Export, replace yes. We don't have document currency. 1 minute. let me add amount in document currency. I'll put this here. And I need document currency. I'll go to D. Document currency. I'll add this here. I'll sum this. Copy. Now let me take this into Excel sheet. Did I close this? Okay. List, export, spreadsheet. Yes. Now, if you see this, everything is local currency. But if I manipulate this, let's say this is dollar, this is Singapore dollar, this is AED, this is VND, this is INR, I'll say this AUD. Now I'll change this number also, maybe 10,000, 38,000, 17,000, just an imaginary figures. 5,600, INR will remain same. AUD I'll say some 7,900. Okay, so assuming this is the figure that you are getting from a particular GL account, which is an open item managed. Any open item managed will show this symbol like red color symbol. This red color represents the transaction is open on a particular month end. If you have to perform foreign currency valuation for this GL account on current month, let's say May 2023, before you configure foreign currency valuation on SAP, okay, before you are configuring foreign currency valuation on SAP, if you understand the concept how this is performed in accounting, according to that, what will be your impact? We have written your foreign currency is always performed for foreign currency and impact is posted in local currency. According to this statement, you are going to perform foreign currency valuation for these entries. Am I correct? According to this statement, foreign currency valuation is performed for foreign currency entries and financial impact is posted in local currency. Considering this statement, from this transactions you are going to perform foreign currency valuation only for the highlighted 4 plus 1, 5 transactions in blue. Am I correct? Yes, no?
Yes.
Now, assuming you know the exchange rate, the current report will give you exchange rate and all, but we need to add that in the layout. You know this amount is equivalent to this amount according to this, but you need to know the exchange rate of all these currency pairs at the end of the month, because at the end of every month we are going to update the exchange rates. What exchange rates? Month end exchange rates, which are nothing but MER rate, month end exchange rate. When you update the month end exchange rate, you are going to put the month end exchange rate in your report, and you need to manually apply a formula or manually calculate on the same Excel sheet, exactly the same report, and do your calculation and arrive at the figure which it is supposed to be the financial impact. In local currency, what will be the impact? Assuming here you are getting some just imaginary figures, 3000 loss, here you are getting 2600 profit, let's say some 6000 here, 1000 here, these are ignored. Here you get some 260. Now if I do a total, this is your 4940. Assuming this is your 4940, this manual calculation we will have to perform before we configure foreign currency valuation in SAP. We will create one GL account, we will pass entries in multiple currencies, let's say some 4 or 5 currencies. Then we will understand how foreign currency valuation actually works, how system is going to calculate the number, and how this is actually calculated from a accounting point of view. Once we do it, once we find out the financial impact, then we are going to configure in SAP. Same GL account we will create in SAP, new GL account, same accounting entries we will pass in SAP. Then we will perform foreign currency valuation for the same GL account. Your SAP calculation must be 4940 what you have manually calculated. There should be no difference. If there is any difference, we need to have clear understanding where something is going wrong. Either things are going wrong in SAP or whether our manual calculations are wrong. You have to be so accurate when it comes to these kind of things, because most of the people will get confused like anything in these areas. Especially when you get foreign currency valuation test run, when you see the number, if you see the number like this 4940, now by looking at the number you must be in a position to tell this is a loss or a gain. So what is my forex impact, or what is my foreign currency valuation impact? You have to be in a position to tell you're getting a loss or you're getting a profit. How this is going to affect your financials? This is straight away going to affect your P&L. Your profit or loss is going to get affected with your foreign currency valuation. Okay, and how the system is going to pass the entries, you'll have to maintain the GL accounts. All these kind of calculations is what you have to understand before performing foreign currency valuation config in SAP. This is very simple configuration. It is not going to take more than 1 to 1.5 hours to learn this. Learning foreign currency valuation is maximum 1 to 1.5 hour activity, provided you have the basic conceptual understanding on this. Otherwise you will be able to do the configuration, but we will not be able to understand why numbers are getting calculated in a different way. How system is behaving is what you have to understand, and make sure that you are able to explain this to your client. And there are certain manipulations that your client wants to do in this. Sometimes what will happen, a particular transaction may be posted for high value. Because of this, you may be having huge P&L impact. Your profits are coming down, or you are getting into loss because of foreign currency valuation. They want to exclude certain transactions. How can we do that? They want to exclude certain accounts. How can we do it? So these kind of things is what we will have to practically understand to ensure that when foreign currency valuation is executed on a particular month end, you are aware of what is exactly going to happen from the financial point of view. Because if your user has executed this, it has given a negative impact on their P&L. Let's say they have seen before executing this, their P&L was showing profit, but after executing foreign currency valuation, their P&L has become loss. They will come back and ask you to explain why my profit has become loss. They will simply tell, no, this foreign currency valuation is not working fine. Please explain me on what basis system is calculating this number. Literally, your client is going or your user is going to ask you to explain the logic behind this calculation. On what basis system has considered this? It is not supposed to consider this entry, or the calculation should be like this. We have to ensure we understand what they are talking, and we have to ensure that we explain them, we convince them how and what system is configured for and on what basis the numbers are being calculated in SAP. To ensure that you are able to convince or you are able to talk at this level, no other option, you have to focus on the concept without SAP. If you get into SAP, if you try to understand, it is tricky part. Because you're trying to look at the SAP screen, you're trying to look at the accounting logic. So these two will not give you the clear clarity in one go. It takes more time. But if you straight away look at in the Excel sheet, if you pass the same entry, you are going to get the same result from SAP. Right? Whatever you are understanding, if the same thing is coming from SAP, you will automatically feel more comfortable. And tomorrow in your interview, if somebody is asking you this, they want you to explain this with an example along with accounting entry, from where these accounting entries are coming. This is one of the mandatory topics to be discussed in your SAP FICO interview. Whether they are asking or not asking, you mention that you worked on foreign currency valuation. Put this point in your resume. These are recurring activities that you are going to do. Every month you'll have to work on this. Clear? On this calculation part alone, on this accounting entry part alone, is this clear? Only this accounting entry, only this 1000 calculation, how we got it. Clear, everyone?
Yes, sir.
Yes.
Right? So read through these points alone. Don't read anything. Don't look at any configuration documents. Nothing is required. Okay, only read through these points. There are some more points that we will have to add, but first read through these points. Make sure you understood this logic. If you understood this calculation, you are clear with foreign currency valuation. There is nothing beyond this. If you understood why you got 1000, you understood foreign currency valuation. Clear? Read through these points. In the tomorrow's session, we will have a practical scenario how exactly this is performed in a real environment on a month end. Clear? But before you understand tomorrow's session or what we are going to discuss about this, I want everybody to read through this, at least have the basic understanding. Clear, right? All right,
Yes, sir.
let me stop this recording.